If you're a Singapore income investor and you're building steady passive income for your retirement, then today's video could help you make one of the most important decisions in your dividend journey. Because we're comparing CFA, the Asia ex-Japan REIT ETF, and YLD, the APAC Financials Dividend ETF, to find out which is truly the best SGX Dividend ETF for passive income, especially with potential Fed rate cuts coming in 2026. Both pay dividends, both are popular among Singaporeans, but they behave very differently, in good times, bad times, and especially when interest rates start falling. And just so you know, all the financial information in this video is downloaded directly from the SGX website. So before we dive in, like this video so more Singaporeans can learn to build smarter passive income, subscribe to Wealth for You, and stay till the end for the final recommendation framework. This video is for education and general information only, not financial advice. Please do your own due diligence. Chapter 1. What is dividend investing and dividend ETFs? Before deciding between CFA and YLD, let's quickly ground ourselves. Dividend investing is simple. You invest in assets that pay you regular cash, monthly, quarterly, or yearly. In Singapore, we call it kopi money, roti prata money, char siu rice money, passive income that makes life syuk and stress-free. A dividend ETF bundles many dividend-paying companies into a single basket. Instead of choosing individual stocks, you get instant diversification, steady income potential, and lower risk compared to buying a single company. CFA and YLD are both dividend-focused ETFs, but what's inside them is as different as Prata Kosong and Prata Egg. Chapter 2. What is CFA? What is YLD? Let's quickly break down what these two ETFs actually are and why they behave so differently. CFA, the Amova-StraitsTrading Asia ex-Japan REIT Index ETF, is essentially a basket of Asia ex-Japan REITs with a very strong tilt towards Singapore, which makes up the majority of the fund. The rest is spread across Hong Kong, India, Malaysia, and South Korea, giving you broad exposure to the region's property markets. It pays quarterly dividends, and as of 18th November 2025, it traded at 83.4 cents. YLD, the Lion-OCBC APAC Financials Dividend Plus ETF, takes a very different approach. Instead of property, it invests in the financial powerhouses of Asia Pacific, DBS, OCBC, UOB, Commonwealth Bank of Australia, Mizuho Financial Group Inc., HSBC, and more. It also pays quarterly dividends and closed at $1.26.6 on 18th of November 25. So the simple difference is this. CFA gives you income from REITs. YLD gives you income from banks and financials. Two completely different engines, but both designed to power the same goal: steady passive income, retirement stability, and more kopi money for your future. Chapter 3. Which gives more dividend income? Both CFA and YLD offer attractive dividend income, but they generate that income in very different ways. CFA, based on its September 2025 SGX announcement and the 18th November 2025 closing price of 83.4 cents, delivers a trailing 12-month yield of about 5.3%. Its payouts come from rental income across Asia's REIT markets, malls, offices, logistics hubs, and industrial spaces across Singapore and the region. YLD, using its SGX reported dividends and the 18th November 2025 closing price of $1.26.6, has a trailing yield of roughly 6.3%. Instead of rents, its dividends are powered by bank profits, insurance earnings, and financial sector cash flows from leading APAC institutions like DBS, OCBC, UOB, Commonwealth Bank of Australia, Mizuho Financial Group Inc., and HSBC. So while both ETFs deliver meaningful income, their engines are very different. CFA earns through real estate rents. YLD earns through financial sector profitability. The yields may look similar at first glance, but choosing between them depends on which income engine you trust more for your passive income and retirement plan. Chapter 4. The Good and Bad of CFA. Okay, so let's talk about the strengths of CFA, which really start with the nature of REITs themselves. When interest rates fall, REITs have historically responded very well. Lower borrowing costs make their operations cheaper and, often, lead to more stable and more resilient DPUs. And because CFA has a heavy Singapore tilt, nearly 68% of the entire fund, investors get to benefit from the stability of some of the region's strongest and most respected REIT managers. It also gives you easy, diversified exposure to Asia's property income, covering markets like Hong Kong, India, Malaysia, and South Korea, all without needing to buy a single building yourself. But, of course, these benefits do come with some important trade-offs. REITs remain highly sensitive to interest rates, and any delay in the expected rate cuts can definitely weigh on prices. CFA's payouts also depend on rental reversions and occupancy trends, which, shift with the broader property cycle. And even though Singapore makes up the bulk of the portfolio, the fund still carries foreign market risks through Hong Kong at about 13.3%, India at 7.9%, Malaysia at 5.5%, and South Korea at 3.5%. One important point to clarify is that CFA is actually the more cost-effective option, with an expense ratio of 0.55%, which is, significantly lower than YLD's 0.83%. So while CFA can really shine in a falling rate environment, investors need to be comfortable with REIT volatility and the ups and downs of regional property markets. Chapter 5. The Good and Bad of YLD. YLD brings a very different kind of strength to the table, because it invests in the financial heavyweights of Asia-Pacific: DBS, OCBC, UOB, Commonwealth Bank of Australia, Mizuho Financial Group, HSBC, and more. Its dividend engine is powered by the profitability of some of the region's most stable and well-capitalized institutions. When the economy is healthy and loan growth is strong, banks tend to reward investors with steady, dependable dividends. This gives YLD a mix of income plus long-term growth potential, something REIT investors don't always get. But financials come with their own set of risks. YLD is 100% concentrated in the financial sector, so if credit demand slows, loan margins shrink, or economic conditions soften, its dividends can come under pressure. Banks also react differently in a falling rate environment. Unlike REITs, deeper or faster rate cuts can compress net interest margins, affecting profitability. And because this ETF was launched only in May 2024, it still has a shorter track record compared to more established income products. So while YLD offers a strong, resilient income engine backed by blue-chip financial institutions, investors need to be comfortable with economic cycles and the ups and downs of the banking sector. Chapter 6. How the 2026 Fed rate cuts affect CFA versus YLD. If the Fed cuts rates in 2026, CFA and YLD are likely to move in very different directions. CFA, as a REIT ETF, is usually a clear winner in a rate cut cycle. Lower rates reduce borrowing costs, support higher property valuations, and help stabilize DPU. With yields looking more attractive compared to safer assets, CFA often sees renewed investor demand whenever rates fall. YLD, on the other hand, faces a more balanced equation. Rate cuts can lift economic activity, which helps banks, but they also shrink net interest margins, a key driver of bank profits. So YLD may do fine in a healthy soft landing, but if rate cuts are triggered by slowing growth, the financial sector may come under pressure. In short, soft landing plus rate cuts means CFA shines and YLD holds up. Weak growth plus rate cuts means CFA stays resilient, but YLD may struggle. Chapter 7. What should Singapore income investors consider? At the end of the day, choosing between CFA and YLD really comes down to your Kopi money personality, the kind of income engine you trust for your retirement. If you prefer the familiarity of property income, CFA may fit you better. It gives you steady payouts backed by real assets, strong exposure to Singapore REITs, and tends to benefit the most when interest rates fall. For investors who value stability and visibility, CFA often feels like the natural choice. If you lean toward the strength of Asia's financial giants, YLD may be more your style. It offers income with a bit more growth potential, exposure to banks across the region, and a way to diversify beyond real estate. Its earnings-based engine appeals to investors who believe in the resilience of APAC's financial sector. Or, like many Singaporeans, you can simply choose both. A blended approach, REIT income from CFA and bank dividends from YLD, smooths out the ups and downs of different market cycles and helps you stay cash flow rich, not just paper rich. Final thoughts. At the end of the day, both CFA and YLD are solid SGX Dividend ETFs that can play powerful roles in a Singaporean's passive income and retirement strategy. CFA gives you Asia's REIT engine, steady, property-backed income that tends to shine when interest rates fall. YLD gives you APAC's financial engine, the strength of banks and insurers driving long-term earnings and dividends. Two different engines, but both leading to the same destination: more passive income, more financial stability, and ultimately, a happier, more secure retirement. If this video helped you understand which dividend ETF fits your 2026 plan better, like this video so more Singaporeans can learn and invest smarter, subscribe to Wealth for You, and leave a comment below. Are you Team CFA, Team YLD, or Team both? This is Wealth for You, helping you build a retirement you don't need a holiday from.